Austin, it's really good to see you. Today, we are talking through 3 ways to maximize your retirement income and minimize your taxes. We've said it before, if you don't have a tax plan, you don't have a retirement plan. So this video is for anybody who's nearing retirement age. We're going to break down a few strategies that people should be considering today. And first on your list is Roth conversions. Why is that?
Yeah, Aaron, this is really a critical planning item. As you mentioned there, if you really are not have a tax plan in place, you do not have a retirement plan.
Right.
And Roth conversions are so important because when we look back at history, we can see that actually tax rates are relatively on sale right now compared to where they were previously. So with that in mind, we want to be sure that we're evaluating this tax deferred bucket, and does it make sense to begin transitioning from that tax deferred bucket into a vehicle like a Roth IRA, paying our taxes today in a historically low tax rate environment, and I will add a known tax rate environment. None of us know where tax rates are going in the future, and I think just the ability of being able to operate in a known tax rate environment is very important.
Especially like you said, when we look back and see how bad it could be. That almost
Right.
gives me anxiety. So next, you suggest people carefully plan their RMD strategy. I think a lot of us think, all right, when I hit a certain age, I'm going to start taking those RMDs, but that can leave you with quite the tax burden.
Yeah, and I think truly having that mindset is it's kind of forced upon you at that point. It's too late to really do much planning at that point. But what we can do is evaluate, does it make sense to begin pulling from those tax deferred buckets earlier before your required minimum distribution age to kind of spread out or lower that tax deferred balance so those RMDs aren't as large. And I think one other important point is a QCD, or a Qualified Charitable Distribution. So this simply states that if you tithe or give to charity anyway, you might as well do so out of your tax deferred bucket, because if you do that and it goes directly to a 501c3 charitable organization, it reduces your taxable income. So that's a little strategy that you can employ, very popular if you do give or tithe anyways.
Right. Okay. And last, healthcare, as we know, is often the biggest expense in retirement, which is why you suggest people consider opening a health savings account now. And that's because they have a unique triple tax advantage.
Yes, Aaron, the triple tax advantage is no joke. This is one of my favorite types of accounts, the health savings account. And of course, as we know, you need a high deductible health plan to be able to contribute to an HSA. But when you do contribute, those contributions are tax deductible, they grow tax free. And upon distribution, if used for qualified medical expenses, they're even tax-free upon distribution. So this is really, as you mentioned, the triple tax threat here with this type of account. If you have access to one, you really do not want to pass up this opportunity. It is a wonderful account when used properly.
Right. These are really helpful strategies. I recognize that after talking it through with you. I think that it would be very valuable to speak with an expert sooner rather than later, before you're close to retirement. So, Austin, if somebody has questions about anything we've covered, what's the best way to reach you?
Yes, you can give us a call at 919-322-4113 or send us an email at info@patriotwealthnc.com.
All right. Austin, thank you very much.
Thanks, Aaron.